We're back. Welcome back to the Wall Street Team. If you've been watching for a while, you'll know that about 3 weeks ago, I made a video on the Russia-Saudi oil war. Go check that out if you haven't. Then the next week, I made a video about negative oil prices, and 3 weeks later, now the US at least is discussing negative interest rates in order to do anything to prevent a recession or a depression. However, there's more than just what appears at the face value, so that's what we're going to cover today on the Wall Street Team. Alright, as always, links are in the description, and while you're down there, go ahead and hit that subscribe button. Anyways, let's begin. We should start off by explaining what negative interest rates are, and it's pretty simple. When you borrow money, you pay back that money later on plus interest in order to compensate for the lender's risk of you defaulting and not being able to pay the money back. If there was no interest, then there would be no incentive to lend. Negative interest rates mean people will get paid for borrowing money, as the lender would pay the borrower for borrowing money. You might wonder then, why would anyone lend? The reason is that negative interest rate policy also charges interest on those who hold onto money, both people and banks. It's better to lend money and pay a smaller interest fee than it is to keep it yourself. We should also realize that while we may be discussing it right now, it probably won't happen for a while. While the president has been pushing for it since January in order to possibly increase his image of promoting economic growth and growing the economy, the Fed chairman Jerome Powell, and therefore the Fed as a whole, is still reluctant to the idea. And since they're the one who would actually implement a negative interest rate policy and push banks in order to charge negative interest rates, it isn't going to happen anytime soon. Decreasing interest rates can stimulate the economy by incentivizing people to borrow. In fact, this has real effects and is one of the key parts of monetary policy. Negative interest rates would be an unprecedented move that has never been seen in US history, and would push this fundamental principle even further by not only incentivizing borrowing, but punishing those that save. Discouraging people from holding money could prevent a deflationary spiral, which is when fear of economic downturn or a declining economy leads to people saving more and spending less. Less spending means less revenue for companies and less fuel for the economy, which itself leads to economic downturn and an uncertain economy. Thus, a spiral is formed, or a cycle, where fear of economic downturn leads to economic downturn, which itself leads to more fear of an economic decline. There are many things like this all over economics, and they pose a tough challenge for central banks. Yet there is a reason why people like the Fed chairman is opposed to negative interest rates, and many of them will point to the fact that it hasn't really worked in the past. Multiple European countries have negative interest rates. In Germany, you can get paid for borrowing money, but it's still gone into a recession during the current climate. Japan has also inducted negative interest rates in an attempt to boost a stagnating economy, but it hasn't really worked for them either. Quote, negative interest rates have not helped the Japanese economy, they haven't helped the European economy, all they do is clog up the banking system, make it more difficult for everybody to operate. In the long run, negative interest rates could be bad and actually hurt the exact thing they're trying to promote, lending. See, normally, as we talked about, when banks and financial institutions lend money, they get paid a little extra back through interest in order for the risk they're taking, in order to compensate for that risk they're taking. However, through negative interest rates, they don't get paid that. In fact, they have to pay a little extra to the person they are lending money to. This disincentivizes lending because there's no money to be made, and it could lead to financial institutions leaving the loanable funds market for good. In addition, while the idea is that you'll be charged interest on money you saved, that's only if you keep it in a bank account. If you take out your money in cash and stuff it under the mattress, there's no way to really keep track of that. How is the government going to know? So they're probably not going to be able to charge interest on it. That means people are incentivized to take their money out of banks and keep it themselves, which means banks have less money to lend. That increases the scarcity of money, which means interest rates could rise and it would make it harder to get a loan. But then again, this might not happen because, again, it doesn't make sense for financial institutions to charge negative interest rates. That's what we were just talking about. And they probably won't. While your credit card rate and mortgage rate might decrease, they probably won't go below zero. That's because the Fed, who would institute or try to influence a negative interest rate policy, they can only do so up to a point. They can only influence things. They can only influence the federal funds rate. They can only influence the interest rate banks charge. They cannot actually set anything. Check out this video here where I talk more about it in depth. In summary, negative interest rates are a last case scenario because while they might be able to stimulate the economy, there are a lot of unknown consequences and things that could result negatively because of negative interest rates. And we're not at that point yet, which is why multiple people, including the Fed, are against that idea. So it probably won't happen anytime soon, but things can always change. Anyways, that finishes today's video. If you enjoyed, go ahead and smash that subscribe button, share the video, and maybe like it. If you liked the video and wanted to watch some more, then you can go ahead and check out the description where I have links to previous videos that I mentioned earlier. definitely go ahead and check them out. I would highly recommend it. Anyways, thanks for watching, and I'll see you in the next one.